Welcome to The Explainer. Today is May 13th, 2026, and we're diving straight into a massive transition happening right now in the crypto market. We're talking about the shift away from those Wild West, chaotic days and stepping directly into a highly surveilled, truly institutionalized ecosystem. We're moving way beyond just sitting around waiting for regulations, right? Instead, we're confronting some deep-seated security reality checks and a huge shift in how institutions are behaving. We've got a ton of ground to cover, so let's just get right into it. So, check out this number, $77,000. Bitcoin is carving out a brand new support floor today. And what's driving this massive move? It's the broader macro picture. We're finally seeing a real easing of geopolitical tensions. We've got reports of an Israel-Lebanon ceasefire, and Iran has declared the Strait of Hormuz completely open for shipping. This sudden geopolitical relief, it's triggering heavy short liquidations across the board, pushing Bitcoin incredibly confidently past that 77K mark. But with all this macroeconomic relief, we really have to stop and ask a pretty crucial question. Because right beneath the surface of all these green charts and rebounding prices, the industry is actually facing an unprecedented security reckoning. The actual literal plumbing of the ecosystem is being stress tested, and we're seeing this new trust discount pop up that could seriously impact decentralized finance for months to come. So here is our roadmap for today's explainer. 1. Market floors and geopolitics. 2. The DPRK DeFi infiltration. 3. Cleaning up crypto's past. 4. AI surveillance and institutional plumbing. And 5. Ethereum's hidden liquidity void. All right, jumping right into section 1. Market floors and geopolitics, establishing the baseline. Like we touched on, Bitcoin is surging past that $77,000 support floor as those major global tensions ease up, completely shrugging off other macroeconomic pressures. But here's the thing, institutional eyes, they're totally neutral and firmly fixed on Washington. Specifically, everyone is watching Thursday's upcoming Clarity Act markup in the Senate Banking Committee. The market is waiting on pins and needles to see the exact text regarding stablecoin yields and crypto fundraising rules. The outcome there could totally flip the regulatory landscape. But for today, the geopolitical relief rally is absolutely taking center stage. Moving on to Section 2, the DPRK DeFi infiltration, a security reality check. Now, the Ketman Project just dropped a report exposing a staggering state-sponsored infiltration. Researchers identified at least 100 North Korean IT workers who have successfully embedded themselves within 53 different crypto projects. And you want to know a wild twist of fate? This critical security research that actually uncovered the whole threat was funded by an Ethereum Foundation stipend. I mean, this isn't just some theoretical vulnerability. We're talking about potential bad actors literally writing code deep inside the industry's infrastructure. And the immediate fallout is perfectly captured right here. A major Solana decentralized exchange had to issue an urgent warning to their liquidity providers, basically saying withdraw your funds right now, after they discovered a direct link to one of these DPRK employees. This is exactly what I mean by that immediate trust discount hitting the DeFi ecosystem. When the developers building the platforms you use might actually be state-sponsored operatives, well, it forces the entire industry to completely rethink its hiring and auditing protocols. Okay, Section 3. Cleaning up crypto's past, the global legal crackdown. We're currently watching the varying degrees of this global crackdown play out all at once. Over in Europe, Spain's market regulators slapped former footballer Gerard Piqué with a fine of over 200,000 euros for a 2021 insider trading tip involving a crypto startup. Meanwhile, stateside, a massive 23-year prison sentence was just handed down to a Texas man for the $20 million Meta OneCoin fraud. That was a legacy retail scam from the 2018 to 2023 era that blatantly lied about being backed by billions in gold and art. So whether it's white-collar insider trading in Europe or just flat-out retail fraud in the US, authorities are systematically sweeping the board clean. Let's dive into Section 4, AI surveillance and institutional plumbing, fortifying the industry. A perfect example of this industry maturation is Zipangcoin. We've got traditional corporate titans, like the Japanese trading house Mitsui Co, actively deepening the integration of real-world commodities right into decentralized networks. By officially launching this tokenized metals asset on Ethereum's Layer 2 OP Mainnet, they're purposefully building robust institutional plumbing. It's designed to provide a really reliable hedge against fiat volatility. It just goes to show we're way past the era of meme coins. It's all about heavy-duty, real-world utility now. And as the plumbing gets better, the surveillance gets a whole lot sharper. Chairman Rostin Bainum recently told Congress that the CFTC is seriously escalating the regulatory arms race. They're stepping away from those purely manual, retrospective investigations and are now firing up Microsoft AI tools for aggressive real-time market surveillance. They are specifically hunting for manipulation in crypto and prediction markets. This tech-driven stance means the regulatory eyes watching the market are finally as sophisticated as the market itself. Finally, Section 5. Ethereum's hidden liquidity void, the next explosive move. Before we get into price potential, we really need to highlight this tactical pause. Tom Lee's Bitmine, which is a massive institutional player, has sharply reduced its Ether buys. They went from scooping up a huge average of 100,000 ETH a week down to just 26,000 last week. Major players are apparently totally content to just sit on their current holdings right now. And honestly, that sentiment is actively contributing to the widespread viewership crisis and retail apathy we're seeing all over social platforms. The big money is simply hitting pause and waiting for clear regulatory signals. But despite that institutional cooling and the current muted price ceiling we're seeing around $2,400, there is an incredibly compelling technical setup brewing. Analysts are pointing to what's called a hidden fair value gap, or FVG. Listen, if the market can just shrug off the DPRK insider risk and focus on the potential for a stablecoin yield breakthrough tomorrow, this massive liquidity void sitting above $2,400 could act as an absolute magnet. Technical analysts are suggesting this is totally setting the stage for a massive, explosive future rally toward that $10,000 target. So the really crucial takeaway from our explainer today is that this ecosystem is undergoing a massive stress test and a massive upgrade all at the exact same time. When you consider the new $77,000 floors for Bitcoin, the geopolitical relief, the systemic cleanup of legacy fraud, and the CFT's AI-driven surveillance upgrades, I want to leave you with this final thought to ponder. As the industry's plumbing undeniably gets stronger and vastly safer, is Ethereum's explosive move into that hidden liquidity void a matter of if or just when? Thanks for diving into this with me today, and definitely keep your eyes on the charts.